Hello and welcome to today's podcast. My name is Ryan Johnson, and today I've got Jason Parr, our CEO, on with me today. Jason, always a pleasure to have you on. How's it going?
Hey, so glad to be here. I'm in sunny Dallas right now, although this picture behind me is not sunny Dallas. It's actually sunny St. George. I note that I'm in a polo and you're in a quarter
Pull
zip.
over. Yeah,
Yeah, that's,
yeah,
I'm guessing in Idaho, it's pretty chilly today.
yeah. I went and donated plasma this morning.
Nice.
Woke up about 5:30, got in my car, and it was 15 degrees.
We don't
So,
make it down to 15
oh,
degrees pretty much ever. That's pretty chilly, but
yeah,
we're actually going to be a warm 78 today. Sunny, beautiful, crisp, and clear. So I wanted to make sure I had
yeah.
the right picture behind me for that.
We've got some pretty good snowfall predicted for today, but I'm okay with that because that means the mountains are getting the snow,
That's
and so
right.
we'll be able to hit the slope soon. So at
Yep.
least we'll have that soon.
There you go.
Yeah. So winter's always a good time if you know and can participate in the right activities.
Correct.
Um, yeah. So Jason, since I've got only you today, I think it would be good just to kind of pick your brain about your uh, vast amount of knowledge when it comes to sales tax. And I thought that today would be a good day to have a discussion on due diligence. 2020 seems to be quite the year of acquisition. We've been seeing companies get acquired and bought and sold all over the place. And
There is a lot of money changing
yeah,
hands
yeah.
in 2020, no doubt.
And and another thing that we've seen is a lot of companies, large companies, are now just starting to become compliant, and they're finding out that they in some cases have quite the large liability. So I was going to see what knowledge you could bring to us about what to look out for in the sales tax world when it comes to due diligence.
Oh, great question. Most companies now, whether they're selling or acquiring, include and understand that sales and use tax is an important part of due diligence. It's probably been that way for the last several years, maybe the last decade, but prior to that, it might have been overlooked. And I can't express enough that uncollected sales tax is a margin killer, but it can also be a killer of the sale. I could give you case study after case study, both that went really smooth and some that went south, where either the escrow was so large that it offset the real value of the sale, or the sale was negotiated down to a lower point because there was a significant amount of sales tax exposure, or in a few case studies where you're really trying to sell and retire, and the sale gets blown up because of exposure and your retirement is lost in the margin killer, sales tax. And so I can't emphasize enough how important it is to take a look at it. But in taking a look at sales tax from a due diligence perspective, obviously, if you're selling, you want to try to understand what your exposure might be and correct that to improve the sale. And if you're acquiring a company, you definitely want to understand if they've got any sales tax exposure or responsibility, because you want to make sure there's an escrow established for that. You don't want to be the successor of liabilities that are coming out of your own pocket. You want to work that into the agreement. So um, the other thing I would say about due diligence is, obviously, once it's identified, you can set up an escrow, you can manage the situation, but a lot of times it's not understood that you can really work to mitigate the actual exposure. So this is no different than we say a company, big three questions, right? Do you have nexus? These same three questions are answered in a due diligence.
Right.
Do you have nexus? Is what you sell taxable? And how do you sell your items, right? All of those matter when it relates to what your actual responsibility is, or if you haven't determined your responsibility, what your potential exposure could be, because you haven't been compliant in that regard. So a lot of times we see this all the time, automated do-it-yourself Nexus study says you owe 7 figures.
Mhm.
Well, there's a lot that goes into, do you have Nexus, is what you sell taxable, and how do you sell it to determine whether you actually have that level of exposure, right?
Right.
Some of your sales might be non-taxable. Some of them might be at a reduced rate. You may have Nexus, but no tax liability. You may have what you sell as taxable, but you don't have Nexus yet. And so it's really important to look at that, whether it's you just trying to get compliant on your own or if it's part of a due diligence for an acquisition. Um, Once that's determined what the actual exposure is, then there's a lot of remedy for
Mm.
correcting that, getting registered, getting compliant, being where you need to be to actually mitigate that, trying to avoid out-of-pocket tax dollars going to the state when it could have been collected from somebody else. So a couple points I would just say overall to kind of encapsulate this. Due diligence should always include sales and use tax. If you're selling a company, you should probably try to figure this out before you're putting yourself out there for sale. If you're acquiring a company, you must look at this because you want to set up the, the the safety net in place to manage that out of the company that's selling. Um, I think that's it for the most part on the liability side. We deal with this a lot, both in identifying and helping companies become
Right.
compliant. But our biggest effort always, I want to make this clear, is to mitigate the actual out-of-pocket tax penalty and interest that a company is paying to become compliant. Um, so it's important if you're in this type of a situation, we really just want to talk to you.
Right.
That's why we always tout the what's next call. Let's have a chat.
Yeah. Now, Jason, I have one more question for you. And in past podcast episodes, we've talked about sales tax audits, and one thing we look at during a sales tax audit is sales tax overpayments, because that could potentially pay down an assessment. Now, are sales tax overpayments something that people should be looking out for in a due diligence when performing due diligence before purchasing or selling their business?
Absolutely. In an audit situation, it's always the best time to be looking for overpayments because not only can it reduce any assessment that might be found and correct any of those overpayments going forward,
Hmm.
the forward savings is significant when you identify where you're overpaying. So it's great in an audit for assessments, but it's also great in an audit because a lot of times you have signed a waiver which expands the statute of limitations for them finding underpayments, but that also opens up that same period for overpayment. So we really tout that. In a due diligence situation, this can be really important. If you're the acquiring company, you do due diligence because you're the successor of any liability that might be on the books of that
Right.
company. And if they weren't compliant and collecting tax, then you could have a significant responsibility there. When you acquire a company, it's just as valuable. Just as you're the successor of liability, you're also the successor of overpayments or recovery that may have been made by
Mm.
that company prior to the sale. So you always want to look into the books and records going back the 3, 4, or 5 year statute of limitations, depending on the state, and look if there's potential overpayments that were made because you're the successor of that, and will be able to retrieve that. So I'm glad you brought that up because that can be overlooked, especially when an acquisition occurs, right? I mean, there's so many startups that are generating significant size companies. They get sold. You're acquired by someone who may have been around for 10 years, 20 years, an investment group, another company, and they just move forward after that acquisition, right? You're building off of those synergies that come from that acquisition, but you actually don't look backwards and see if there was potential overpayments that were made that could be recovered. So good question on recovery within an acquisition or a sale.
No, thanks for the answer. And I know, this will be very beneficial to a lot of our listeners. Um, so like Jason said, in our What's Next call, and we can cover any situation you may be in. And a lot of times it's just covering those 3 questions that we always ask. And we talk about those 3 questions in great depth last few podcasts. So make sure and
We did, yes.
make sure and go listen to those. Lots of great information, and it may convince you that you need a What's Next call. We talk to everybody, and we want to. Um, that's why it's free. That's why it's there, because everyone wants to know what's next. What do they do? And we're ready to answer that question. So Jason, thank you again so much for being on with me today.
You bet,
And
Ryan.
I know I'll see you on another one.
All right, take care.